Okay, I think we're going to go ahead and kick it off. It's a couple minutes after 9 here. So good morning, everybody. Welcome to Stark Community Foundation's 2023 investment webinar. I'm Carrie Bass, the CFO for the foundation, and we certainly thank you for joining us today. It's my pleasure again this year to introduce Marquette Associates, including both Chris Caparelli and Evan Frazier. Most of you are aware we've been with Marquette, it's hard to believe, for almost 5 years now. Chris is the managing partner for the firm, and he has over 15 years of investment experience with a focus on nonprofits. Evan, on the other hand, is a senior research analyst, and he does significant work on the due diligence side in terms of manager analysis. So we're very excited to have them today, particularly in this environment. There's a lot going on with headline risk, including geopolitical risk, rising interest rates, inflation, issues in Congress, strikes, the list seems to go on and on. So we're definitely interested to hear what they have to present to us today. Few quick housekeeping items for all the participants. First, all the audio and video has been turned off. If you do have a question, we ask that you put that question in either the chat box or the Q&A, and we will do our best to address those questions at the conclusion of the presentation if time permits. So again, to all of you, we thank you. We thank Chris and Evan. We appreciate the relationship all of you have with Stark Community Foundation. We're excited to get started here. And so with that, I'm going to turn it right over to Chris Caparelli with Marquette Associates.
Thanks, Carrie. And thank you all for being with us this morning. It's a real pleasure to be able to chat with you, at least virtually. And, I'll say, yeah, it's been a quick 5 years, but it's been a really enjoyable time frame for us. Working with, Carrie and Bridget and Mark and the rest of the staff at Stark Community Foundation has been great, and the board and the investment committee. So it's been a really good experience. Hopefully we've been able to drive some good outcomes, and we'll be able to continue to do so going forward. And certainly there's a lot kind of always swirling around us in the capital markets. So I'll spend just a few minutes talking through some sort of high-level overview on Marquette and a little bit of our work with the foundation. And then I'll turn it over to Evan. We had our annual client investment symposium just a few weeks back, and Evan is going to sort of rehash one of his talks from that meeting, which we thought was particularly interesting, and hopefully you guys will agree and think so as well. So just quickly on the intro side, Carrie did a great job of introducing us already, but I'm a field consultant, so I work with a handful of organizations very similar in nature to Stark Community Foundation. And then Evan is on the research side of our firm, who does capital market and manager research. So that's a little bit of the way we split our responsibilities. Hopefully a number of you are familiar with Marquette already, but kind of who we are is maybe not a household name. We work with almost primarily institutional investors across a number of different client types, primarily nonprofit, public pension funds, and then maybe Taft-Hartley pension funds. Have about 140 employees. We are 100% employee owned, based in Chicago, with a few other satellite offices around the country. Here's just a look at sort of our representative client list. Have a lot of nonprofit names on the board here, as well as some Ohio names that perhaps you guys would recognize. And if we think about sort of what we do and what we do well, it's provide investment advisory services to organizations just like Stark Community Foundation. So kind of the median client size for us is somewhere in that kind of few $100 million to maybe $1 billion range. And I think that's where we do, probably some of our best work. We're an independent consultant, so all we do is provide investment advisory services. We are 100% employee owned and have no conflicts of interest. So what that means is it allows us to be beholden just to ourselves as shareholders and partners and employees of the organization and our clients. So we're only responsible to those sort of two entities, which keeps the business model pretty clean. And while we're probably not always going to provide the most accurate financial advice, we're not always going to be right. When we make decisions, they're kind of grounded in research and it's sort of with the best available information we have at the time. So our clients never have to wonder, hey, is there an ulterior motive for making a recommendation? It's purely to kind of drive the best outcomes in our client portfolios. And that allows us to have a high degree of alignment of interest and alignment of mission. So our goal here is to allow our clients to be better stewards of their sort of investment capital, to allow folks like Carrie and Bridget and Mark and the rest of the staff at the Community Foundation to continue to do the good work with the donor dollars that you all do out in the community. So it kind of allows the two organizations to work seamlessly with one another. And if we sort of boil down our overall process into a couple words, it's to build high quality investment portfolios, keep a very close eye on risk, both statistical and making sure we're partnering with the right types of organizations, and then keep costs low. There's a lot of stuff that's outside of our control within the sort of course of capital markets, but the one thing we can control is how much we pay and who we pay it to. And as a result, that's something we focus on a lot as we go through sort of our normal monthly and quarterly meetings, with a big focus on cost, and that every dollar that can sort of stay in the portfolio and is not paid to external investment managers is another dollar that can be sort of put back to work in the community. So we think that's a pretty big and important focus of ours. So there's a lot that we do on an ongoing basis, and obviously there's a lot happening in the capital markets around us. But when we sort of take a step back and sort of think of our big picture objective, it's to generate returns that are in excess of spending and in excess of inflation, to keep the portfolio growing in real dollars over a long-term time frame. In order to do that, we think the most important sort of factor in building portfolios is high-level asset allocation. There's obviously, other things that go into it, like manager selection and moving parts of the portfolio around, and they're all important. But that high-level asset allocation is the thing we spend the most amount of time on, and that we think that's what's going to drive your returns over the next 5, 7, and 10 years going forward. And so to say that, we build portfolios based on asset allocation, we're strategic investors, we're not trying to time markets or be overly tactical. That's not to say that we don't make changes in the portfolio, and certainly, the world around us sort of dictates the way that we make those changes. Over the last couple of years, we've seen a lot of different and sort of moving parts within the overall capital markets. And the biggest one has been an inflationary environment, unlike anything we've seen here in America in 40 years. So if you look just sort of at the current sort of inflation environment, last summer, inflation was running at maybe 9% year over year. And while it has come down, it has not come all the way down. The Fed has a long-term target of 2% for inflation. At the most recent readings, depending on what metric you look at, it's closer to 3%. Meaning that the Fed has achieved a good part of their objective in getting inflation down and inflation under control, but the job maybe is not finished to have kind of full price stability here in the U.S. The primary tool, and it's somewhat of a blunt tool, but the tool that they have used to get that inflation back under control are changes to short-term interest rates. Interest rates affect really all parts of the economy, and I imagine we've all felt it to some degree in the changing interest rate environment. And how dramatically that's changed over the last couple of years is been in a big way. If you rewind the clock back to early 2000 or late 2021, the Fed funds rate was effectively at 0%. So overnight borrowing was around 0%. And you could buy a 10-year treasury bill that paid you around 1.5% over the next decade. A pretty paltry level of return. If you look on the left-hand side of this chart, these are all the sort of short-term interest rate hikes that the Fed has executed over the last, let's say, 18 months. And that has taken the short-term interest rate from 0% up to about 5.5%. And just yesterday, or I think Friday, for the first time since 2007, a 10-year U.S. Treasury bill now hit a 5% interest rate. So we've seen a dramatic shift in a fairly short period of time. And that's causing sort of all sorts of market participants in different asset classes to sort of revalue and reprice given this new interest rate environment. Going forward on the right-hand side of the chart, this is sort of what the market's expectation is for future interest rate movements. And at the moment, it sort of seems like the market is expecting the Fed's sort of tightening campaign to be ending relatively soon. Maybe there's 1 or 2 more interest rate hikes left. But before too long, the market is pricing in the Fed starting to go the other way and maybe starting to cut rates a little bit. So this has been sort of the biggest factor in markets over the last kind of year and a half or 2-year period. And it's not that a 5% interest rate in and of itself is all that problematic. If you look back through history, that's pretty, common, going back to maybe the 40s and 50s. But what is not common is the rate of change and how fast it happened. It happened in a very short period of time, and it happened quickly. And that's what sort of causes the volatility that we've seen in capital markets over the last few years. So, how do we think about responding to that environment? We are long-term capital allocators trying to build portfolios that are sort of all-weather over 5 and 10-year periods. So we have a capital market the next decade. And if you look at sort of how this model has worked over the past 10 years, we're thinking about just two asset classes here, very simply stocks and bonds. The sort of modeled or expected return for the stock market has been fairly consistent over the last decade, although it has come down as we've seen really strong returns over the last 10 years. And today, if we run our simulations in our software, it says you can achieve about a 7% return from equities. What has changed dramatically over the last couple of years is what the model expects you to earn from the bond market. So just a few years ago, the expected forward return from fixed income was about 1.5%, and today it's closer to 5%. And sort of the relative attractiveness between those two sort of building block asset classes has changed, and as a result is sort of getting us to think a little bit differently about portfolio construction, because it had been such a long period of time that rates had been so low. And as a result, we had to take a lot of risk in portfolios. And today we've got an opportunity to perhaps dial back some of that risk, given the much more favorable interest rate environment that we have today. So the last slide just looked at stocks and bonds. Obviously, there's a lot more parts to the overall capital markets that we utilize in a portfolio like the Community Foundation. And so as we think about how all of those other asset classes affect the return we're trying to achieve, you can see all these kind of various data points across the chart here. And that North Star, or that real long-term objective for us, is about 7.75 percentage point. That's the number that we think we need to hit in order to keep the portfolio growing in excess of spending and in excess of inflation. And you'll notice, there's asset classes on both sides of that line. But by and large, a lot of the asset classes that we have in the portfolio and the mix of those asset classes are all fairly close to that number. And that would not have been the case a couple of years ago. A few years ago, some of these fixed income data points in these blue circles here would have been down in this lower left-hand corner, meaning we would have had to use, more riskier asset classes and a larger percentage to hit the long-term goal. And today, I think the job of all asset allocators has gotten a little bit easier to hit those long-term targets, given the higher interest rate environment that we have today. So just a quick look at maybe how the portfolio has changed over the last few years. As Carrie mentioned, we've been working with the foundation about 5 years now, and it's been maybe 4 years since sort of the portfolio that we helped build has been put in place. And I'd say there's a few themes here as you look across the broad asset classes. If you focus on just sort of the light blue areas of the portfolio, you think about half of the overall portfolio is in publicly traded equities, both in the U.S. and outside the U.S. That certainly is a big focus of ours. That is going to be probably the biggest driver in returns over the next 10 years, but it's also going to be the biggest source of volatility from day to day in the portfolio, as the public equity markets are always moving and incorporating information in a very efficient manner. And then as you look around sort of the other slices of the pie chart, I think one of the things we're focused on at Marquette is using alternative investments. And I use that term broadly to encompass anything that's not stocks and bonds. So hedge funds, other alternatives, real estate, infrastructure, private equity, private credit, using those asset classes both in a fairly significant way to make sure they're meaningful to the overall portfolio, but being careful about the way we deploy those assets, because they have a few attributes that public equities and public fixed income don't have, which is typically higher fees and less liquidity. So if we're going to pay more and perhaps lock up capital for a period of time in those other asset classes, we need to be really certain about their role in the portfolio and feel really comfortable about the types of managers that we choose to deploy in those areas, again, given the higher fee and lower liquidity sort of structure. So as we think about sort of that broad asset allocation, it really for us comes back to the investment policy statement as a way to primarily control the risk in the portfolio. There's lots of ways to measure risk, statistical, and then maybe at the underlying manager level. But we think it's really this investment policy statement that is the living, breathing sort of embodiment of the portfolio. And it really should serve as the institutional knowledge in the portfolio. So in the event that folks around the investment review committee or even an advisor like Marquette weren't here in 10 or 15 years, this policy should allow sort of anyone to step into the room and say, hey, we have a pretty good idea of the objectives that you're trying to achieve here. And the policy should, to some degree, force us to make some uncomfortable decisions when markets get volatile. You think back to a 2008 timeframe, when stocks were down 30, 40, 50%. It's the investment policy that reminds you of the long-term objective and maybe has you rebalance back into equities at a time where our human nature is sort of screaming at us to do something different. So we really kind of utilize this policy as that overarching risk control on the entirety of the investment program. So once we have the asset allocation built and the investment policy set, it's time for us to find what we think are the best sort of in-class investment managers in each one of the various asset classes. We spend a lot of time doing manager due diligence. Evan and his team do a lot of work on that front. And for us, there's sort of no silver bullet to identifying some of the best investment managers out there. It just takes a lot of meetings and it takes a lot of time and energy and effort to get to know the investment managers that we ultimately recommend that our clients place capital with. And while we're certainly looking for managers that have displayed a really strong track record, returns are obviously very important. It's not the only thing we're focused on. We want to make sure that in addition to generating strong returns, we want to invest capital with managers that have a like-minded sort of attitude towards capital markets and making sure there's a strong alignment of interest, that they are, recognizing that they're investing the community foundation's dollars and they take that sort of responsibility seriously. So it's not just about finding managers sort of with the best track record. We want to make sure we're comfortable investing alongside them as well. Here's a list of sort of a representative asset manager roster across the foundation. This is just a handful of names of some of the underlying managers that go out and execute on the asset allocation that we put together with the investment review committee. Certainly, there's some household names on this list. You look at a group like JP Morgan, everybody probably knows them, or BlackRock, one of the largest asset managers in the globe. But if we're doing our job right, not every manager on this list is hopefully a household name. There's probably a few smaller boutique managers out there that maybe aren't quite as familiar to the overall investment landscape. And this is really a result of our due diligence process, and that we're trying to find the best managers in their respective asset classes sort of around the country, if not around the world. And that certainly a group like JP Morgan is very well respected and we think does some things very well. But it's unlikely that any one asset manager does everything well. And it's sort of another layer of diversification by utilizing all these different groups. Again, find sort of that best-in-class asset manager roster across the entirety of the capital market spectrum. So while we're not only focused on performance, certainly this is a performance-based business, and there's a track record that gets published on a regular basis to keep an eye on performance. We think we've been able to generate a pretty strong track record relative to our sort of internal benchmarks that we have for the foundation over sort of the 1, 3, and 5 year period. Generated some nice sort of excess return above the benchmark. And that's really, hey, has the manager selection effort been fruitful? And have we been able to find managers that can sort of execute on their mandates and outperform their benchmarks? And then the second way we look at performance, this is not necessarily the long-term objective. That long-term objective is 7 3/4, generating return in excess of spending and inflation. But we recognize that there is sort of a limited supply of dollars out there. Donors have a lot of opportunities and a lot of options to donate funds and sort of create a legacy. So we need to sort of keep an eye on what our sort of peer benchmarks and peer comparisons are doing to make sure that the Stark Community Foundation presents itself as a really long-term and attractive place to donate capital to. So here's where if we look at performance against a very wide swath of other nonprofits across the country, we think the returns stack up pretty favorably here as well. Happy to report that the track record looks pretty strong, both against the benchmark and against peers over a fairly long-term basis. And then maybe the last thing to think about is, hey, how does that performance track record, versus peers, why does it matter and how do our peers look? I think it's always important to keep an eye on how our peers are allocating capital. Not that we want to be exactly like our peers, but there is some wisdom in crowds. So in the sense that we want to be different from the peer group, it's important for us to sort of have a good, well-reasoned thought process behind it. And maybe, a couple takeaways from this slide that kind of goes back to the pie chart is that we probably have a little less public equity in the portfolio than many of the peers around the country, and as a result, have a few more dollars invested in some of the alternative asset classes that we think can really generate and drive returns over the coming sort of 5 and 10 years. So I will take a pause there and happy to take some questions maybe at the end. In the meantime, I'll turn it over to my colleague, Evan. Evan had just, as I said before, given this a very similar talk at our investment symposium a couple of weeks ago about globalization and perhaps deglobalization, which is one of the trends in the market today. And so with that, I will turn it over to Evan. And Evan, if you want to just direct me to the right slide, we'll get through your part of the presentation.
That sounds like a plan. Well, thank you, Chris, and thank you all for joining today. Very excited to be presenting this portion of the presentation, which we've titled "What Might De-Dollarization and Deglobalization Mean for Equity Markets?" In terms of the agenda, so we'll plan to review the last few decades, sort of leading up to 2008, thereabouts, and discuss the causes of globalization and their impacts. Second, we'll focus more on the last 10 to 15 years and identify trends that have led to less global integration, less globalization. And lastly, we'll discuss how these trends may impact equity portfolios and equity markets and really the broader macroeconomic landscape going forward. So we can kick things off with some definitions. And if you've read any articles or listened to any podcasts about globalization, you may have heard about one or all of these terms already. But so globalization is sort of the process of increasing integration or connectedness of people, companies, countries throughout the world. And so it stands to reason that deglobalization is sort of the opposite of that, right? It's the reduction of integration of people, companies, countries across the globe. And then since much of globalization and deglobalization is centered on global trade, we have several terms here on this slide that are used to describe recent trends within that context of trade. So nearshoring is the shifting of some or all of a company's supply chain operations closer to their domestic market. Reshoring is the shifting to the domestic market. And then friendshoring is the shifting of supply chains or centers of production to friendlier markets. Excuse me. These three things can result in what we call a China plus one policy, meaning that companies keep their China operations, but maybe diversify or add additional production hubs elsewhere. And then finally, de-dollarization means less reliance on the US dollar as the currency for global transactions. So those are the definitions. Now we can maybe turn to globalization and look at it over the last, call it 50 or so years leading up to 2008. We'll look at the full trajectory of this metric in a minute here. But, in order to really measure globalization, we do need some metric, right? We need some unit of measurement with which we can assess globalization trends. And so the metric we're going to use is global trade as a percentage of global GDP. And as you can see here, we can see a steady rise in this metric since the mid-70s and a very strong, consistent rise really from the mid-80s up through 2008. And over that 20 or so year period, global trade as a percentage of global GDP rose from less than 35% to more than 60%, which is obviously a very dramatic increase. And you'll see noted here on this slide, there were several key events, specifically in the 90s and early 2000s, that kind of pushed this number higher. So for instance, you had the end of the Cold War, which literally broke down barriers. You had the enactment of the North American Free Trade Agreement, or NAFTA, the creation of the WTO, and then the inclusion of China in that organization in 2000. So each of these world events really had a tremendous impact in terms of influencing and increasing global trade. But we think it's important to highlight that globalization isn't just about global trade or economics, though. There are also social and political components to globalization. And really all of those components increased dramatically in the 90s and 2000s. So for instance, on the social front, we've seen tourism and travel increase, as well as an expansion of student exchange programs. And then on the political front, we've seen more trade treaties, as well as increased NGO, non-governmental organization activities like peacekeeping missions during that time. So we've sort of established that globalization has occurred, but now we can kind of ask ourselves, okay, well, what kinds of impacts have these trends had on the world, and specifically the markets? So as far as impacts go, we can start with correlations across equity markets. And just to be clear, when we're talking about correlation, we're talking about the extent to which two variables are sort of moving in tandem with one another. So a correlation of one implies that the two variables that we're measuring are moving in lockstep with one another, whereas a correlation of -1 implies movement in opposite directions. And so this chart shows a material increase in the rolling 5-year correlation between the S&P 500, which is domestic large cap, and the MSCI EAFE, which is non-US developed large cap, over the last few decades. That's represented here by that blue, the darker blue line, I suppose. That figure was around 0.4 during the 70s and 80s, and then jumped up to around 0.7 in the late 90s when those globalization trends that we discussed really took off. And it currently sits at about 0.9, which is indicative of a very strong positive association between US and non-US developed market equities. And although the emerging markets benchmark has a shorter history, you can see a similar story there represented by the lighter blue line. You may be asking yourselves, okay, well, why is this important for us? Well, one justification for non-US equity exposures in portfolios like yours is that the space theoretically provides diversification benefits at the portfolio level, which can allow for smoother patterns of performance over time. But recently, those benefits, I would say, have been minimal at best. And that's in large part due to the fact that markets are much more globally integrated now. So in other words, the supply chains and revenue streams of companies domiciled here in the US can and often do look very similar to those domiciled elsewhere, and that can cause similar patterns of performance to arise. Globalization trends also fueled a rise in the prominence of the dollar, which has essentially served as the world's reserve currency since the end of World War II. Now, when we're talking about a reserve currency, we're talking about one that's held by global central banks and treasuries that can be used for international transactions, as well as to influence domestic exchange rates. And as it says here on the slide, a variety of factors kind of led to the dollar's emergence as the world's reserve currency, many of which I would say tie into this theme of globalization. So for instance, a rise in the prominence of international trade, combined with the fact that the US is an economic superpower, means that it's important for countries, I would say, to hold the dollar in order to effectuate cross-border transactions. So there are many benefits of having the world's reserve currency. One benefit would be the power of the US to impose sanctions against foreign countries, including the freezing of reserves and the removal of banks from the SWIFT platform, which can decrease a country's ability to transact across borders. In other words, the dollar can effectively be weaponized against countries that are deemed to be a threat to American interests. Additionally, the world's need for dollars has allowed the US to borrow and import goods at lower costs, while at the same time attracting a significant amount of FDI, foreign direct investment. And as you can see here on the slide, both US imports as measured by the trade balance, as well as FDI, have mostly ticked up since the 90s as globalization trends have proliferated. So another key impact of globalization is the ability of companies to outsource labor to the cheapest markets. And as a result of that trend, we saw millions of manufacturing jobs leave the US over the last several decades, many of which ultimately ended up in China due to that country's labor cost and labor market advantages, some of which you can see here on the slide. So for instance, in the mid-90s, China's working age population was almost double that of G7 countries, and Chinese manufacturing workers were paid an average of just 40 cents per hour during that time. That was around 2% of the average hourly rate in the G7. As a result of these dynamics, China's share of world good exports ballooned from, I would say, around 4% in 2000 to over 15% just a couple of years ago. And so here in this country, labor costs as a percentage of GDP, as you can see, fell from over 65% or thereabouts in 1970 to around 60% in 2019. So this meant that working and middle class workers experienced stagnating real wage growth over that period, but there were two key benefits that they gained. So one was cheaper consumer goods due to those imports, so they could buy more stuff. And they also had more access to credit, so they could also buy more stuff. So likely related to those manufacturing job losses that I talked about on the previous slide, we've also seen union membership in the United States fall over the last few decades. So here we have data that goes back to the early 80s, when union members as a percentage of employed individuals were around 20%. But by 2022, that figure had been cut in half, and it's about 10% now. But what's interesting, though, if you look on the right-hand side of this chart, is the fact that U.S. citizens have become much more in favor of unions over the last decade and a half, with current approval ratings just over 70%. We think that this reflects the American public's dissatisfaction with the state of wages here in this country. And wages have certainly influenced U.S. corporate profit margins in the last 20 plus years. Perhaps unsurprisingly, as labor costs have fallen, company profits have improved. So after-tax corporate profits for U.S. companies as a percentage of GDP, represented by the blue line and corresponding to the right axis here, more than doubled from the early 90s through 2021. Some of this is wages. Some of it is just a function of globalization having allowed U.S. companies to really diversify their customer exposures across geographic lines. And to that point, now over 40% of revenue for S&P 500 companies, which obviously domestic equity benchmark, is now derived from overseas. And globalization has also helped to keep inflation around the world relatively muted. Again, we're looking backward here. Obviously, over the last couple of years, much has been made about elevated price levels. But if you split this chart down the middle and assess average inflation over each interval, you get two very different stories. So from the 70s to the late 80s, global inflation ran at about 9% on average. But from the early 90s up through 2021, that figure was closer to 4.5%. And this should make kind of intuitive sense, right? Trade integration, reduced barriers to access for market participants across the globe. That had an effect of increasing competition in imports, which led to the relocation of production to more cost-efficient countries. And all of these factors have helped to keep price levels down, at least for the most part. So globalization may not have led to goods and services price inflation, but what it likely did contribute to is asset price inflation, specifically within equity markets. So from the 70s to the 90s, the S&P 500 traded at about 12 times earnings on average, compared to over 23 times from the 90s through 2021. And much of this, I would say, is a function of that low interest rate regime through which we lived starting in the 90s and continuing until very, very recently. And, of course, when yields are low, investors typically allocate more towards stocks. That can result in higher equity multiples like the ones we've seen in recent time. And those low rates are, at least in some respect, thanks to those downward inflationary pressures that we detailed on the previous slide, which were partly due to increased globalization trends. So if the United States was the winner of the globalization game, China was perhaps the silver medalist. As you can see here, the Chinese economy expanded rapidly starting in the 80s, continuing to the 90s and 2000s, growing at an average of 9% or higher in all of those 3 decades. And even into the 2010s, you can see an average growth rate of just under 7% for that country, which still made it one of the fastest growers in the world. And indeed, China really kind of liberalized a lot of its policies, at least relative to where they had been, starting in the 70s and 80s, really opening itself up to foreign trade and investment after a period of economic isolation. And since that time, it's become a major player on the manufacturing stage, thanks to what we'll call, labor costs, labor market advantages, and has emerged as a key trade partner for the U.S. and other nations. In fact, according to the Chinese government, China was the largest trading partner for over 50 countries in the mid-2010s. And what's more, China did just $14 billion worth of merchandise exports in 1979, compared to over $2.5 trillion just a couple of years ago. So certainly very rapid economic growth for China in a relatively short period of time. So I thought it would be helpful to kind of summarize some of the effects that globalization has had on equity markets and the macro landscape before we look to the present and future. So first, interest rates and global inflation trended below long-term averages starting in the 90s until really the last year or two. Additionally, correlations between U.S. and non-U.S. equity indices increased, as did corporate profits here in the U.S., while wage expenses have come down. Additionally, China's economy grew significantly, and that growth allowed that country to really emerge as a global power. And finally, the dollar kind of entrenched itself as the reserve currency of the world thanks to the continued strength of the American economy. But that was then, and this is now. More recently, there have been several currencies that have resulted in reduced globalization or deglobalization, as some have called it. I think the most obvious one is COVID-19, right? The pandemic kind of called into question the resilience and reliability of global supply chains, especially those centered on cost efficiency. Additionally, you had the Russian invasion of Ukraine, the Brexit referendum in 2016, and then the souring of US and China relations. All of these things have led to less coordination and less integration across the globe. And we've also seen several countries looking to reduce their respective dependencies on the US dollar over the last couple of years. So with all of these things in mind, we can revisit our key metric of globalization, world trade as a percentage of world GDP, and examine the last 15 years. So we can see that global trade as a percentage of global GDP peaked in 2008 at around 61% and has since trailed off to just over 55% as of the most recent reading in 2021. So given this trend of deglobalization, or what I've heard referred to as slowbalization, we can ask ourselves and look at other trends that we've seen emerge. So we have also seen the dollar as a percentage of total global reserves decline over the last 2 decades somewhat. So as the green bars here indicate, the dollar made up over 70% of global reserves at the beginning of this century, compared to less than 60% at the end of the first quarter of this year. And at the same time, other currencies like the euro, which can be seen in light blue, and the yuan, which can be seen in orange, have gained in prominence. And additionally, usage of the dollar in FX market transactions has also seen a slight decline over the same time period. Now, there are a few reasons for this. So first, when Russia invaded Ukraine, the US froze over $300 billion worth of Russia's foreign currency reserves. That forced Russia to utilize other currencies, including the yuan, which is now the most traded currency in Russia. So other countries may be looking at that situation and wondering if disagreements with US foreign policy will lead to their assets being frozen. That type of sentiment, I would say, has likely pushed some to utilize alternative currencies. There's also this idea that diversifying reserve holdings into a more multi-currency type of portfolio can reduce certain domestic macroeconomic pressures. So, for example, when the Fed started hiking rates last year, a lot of central banks around the world were forced to follow suit in order to prevent significant capital outflows and depreciations of their own currencies. So I would say there's increasingly a belief, especially among countries in places like South America and parts of Asia, that they may not want to be so beholden to the macroeconomic fortunes of the United States. So we're also starting to see changes to global supply chains and global trade. So in Europe, for example, the trade relationship between the EU and the UK has certainly shifted post-Brexit. So as you can see here, UK imports to the EU on a volume basis are down significantly since June of 2016, while trade volume within the EU has risen by 64% since the Brexit vote. And we've also seen changes here in the US in terms of trade dynamics. So imports from China, for instance, have fallen since 2018 from 14% to 11% of total US imports. And at the same time, imports from places like Mexico, Vietnam, South Korea, Taiwan, et cetera, have increased from 14% to 18%. And this has certainly created, I would say, some interesting investment opportunities within the EM space outside of China, which we can get into a little bit later. So we thought it would be interesting to kind of bring this home, bring this to life with a real life example of a shift in supply chains. And what we have here is Apple's plans to increase their non-China manufacturing exposure. So you can see a bunch of different products here. We can focus on the iPhone, for instance. So the iPhone's non-China capacity is estimated to increase from 6% last year to around 25% just a couple of years from now. And you may be asking yourselves, okay, well, where is this capacity moving to? Well, South and Southeast Asia, I would say, are expected to become big beneficiaries of these changes. So according to Bloomberg, Apple assembled more than $7 billion worth of iPhones in India for the fiscal year ending March of 23. And other countries like Vietnam, Malaysia, Thailand are expected to benefit as well. And I should say many other companies are following in this path where they're attempting to diversify their supply chains. And that typically means less trade for China. So essentially in the 90s, there may have been more of a focus on efficiency and cost. But today, in light of some of the stuff that we've detailed earlier, there's more of a focus, at least on the corporate side, on resilience and reliability of supply chains. And perhaps uncoincidentally, China's GDP growth has fallen and is expected to continue to fall from the double-digit growth that we detailed in the 90s and 2000s. So the CME now expects this decade to average around 3% in terms of GDP growth for China. Now, there are several factors that are pushing this number down, including a higher base GDP, a slowdown in China's property sector, and a shift in political focus. But certainly shifting trade dynamics have most definitely had an influence on this number. And there was actually there's a 60 Minutes piece this weekend. I don't know if any of you saw it, but basically they gathered the heads of sort of the biggest intelligence agencies in the US, UK, a couple other countries, and asked them what the biggest challenge facing the West was right now. And in no uncertain terms, everyone basically said China was not only the biggest risk going forward, but has been actively engaged in some of the most egregious corporate espionage that we've seen sort of on an unprecedented scale. So that is going to make a lot of Western countries and businesses increasingly unlikely to work with Chinese entities if they feel like their trade secrets might be put at risk because of those dealings. So I do recommend checking out that report if you haven't already, because it's very, very eye-opening and frankly a bit concerning. Okay, so with all of that being said, what do we think these shifts in global trade mean? So if we look at the first 20 years of this century, we think that a case can be made for higher inflation, higher interest rates, higher wages going forward. We also think a similar case can be made for lower U.S. corporate profits, lower correlations across global equity markets, and less reliance on the dollar, though the latter is likely to happen a lot more slowly. So to wrap all of this up, we can think about how these trends might impact equity markets and equity portfolios, and we think that there are a few things to highlight here. So first, just emphasize the fact that it's important to maintain a balance of U.S. and non-U.S. exposure at the equity composite level. So as I'm sure you're all aware, the U.S. has enjoyed a strong, really unprecedented run of outperformance over the last decade plus. That has led to inflated valuations for domestic indices relative to their non-U.S. counterparts. Right now, the MSCI ACWI, which is a common representation of global equity markets, is roughly 60% US, 40% non-US. So we think having portfolio exposures that are somewhat along those lines is a prudent thing to do. Similarly, mega cap growth has dominated in recent times, so paring back excessive exposures to that space should serve investors like us well, at least from a risk control perspective, given the potential for higher for longer rates and the lower equity multiples that typically arise due to that type of an environment. The third one here we have is value stocks. We've been emphasizing that point sort of for a while now. They held up relatively well last year as we saw growth sell off. And we think should we see a sustained climate of higher rates, higher inflation, more CapEx spending, et cetera, going forward, we may see stronger relative performance from value style equities. But at the very least, there's a diversification benefit. We should be able to get there. And then speaking of diversification, emerging markets, so increased deglobalization could result in that space exhibiting a more uncorrelated return pattern relative to domestic equity indices. And then as far as absolute performance goes, it's obviously been a challenge space of late, but we do think that there are those pockets of the asset class that could stand to gain from those trends that we've discussed. So for instance, EM countries like Mexico and others in Latin America could benefit from nearshoring trends. We've seen many of those countries materially increase exports to the US, as we discussed in recent quarters. Plus, many of them have either stopped hiking or actually started to reduce interest rates over the last couple of months. All of that tends to be good, not just for economic growth, but also equity market performance. And finally, I think it's just important to remember the role that actively managed strategies can play in certain areas of the equity market. And EM is actually a good example. So not only is it a relatively inefficient market, but China, which we've categorized as potentially being challenged in the near term, makes up over 30% of the MSCI Emerging Markets Index. So if we feel like China may further deteriorate due to increased deglobalization or other factors, it's not a whole lot of use to just buy the index. Whereas if you hire an active manager, they have the ability to go where they see the most value and opportunity, either from a bottom-up or top-down perspective, or both. So we think that these are all things to be thinking about as it relates to your portfolios and the question of potential further deglobalization. So that concludes this portion of the presentation. Carrie, I guess I'll turn it back over to you now.
Okay, Evan, thank you. Maybe one quick question for you, Evan, if you don't mind. Could you talk a little bit more specific to, how these trends have impacted performance of the equity market?
Yeah, so I think it's difficult to link longer term performance for certain countries to macro related trends like deglobalization or anything really. But you have seen performance patterns that I would say align pretty well with the trends that we've discussed today. So, for instance, Chinese equities are down double digits over the last several years. Again, part of that is their property sector issues, geopolitical issues. But if Chinese companies are doing less business with the West, that's certainly going to have an impact on performance. And a weaker China, I would say, has weighed on the performance of EM indices more broadly. Though you do have those bright spots in LATAM from a performance standpoint. Brazil and Mexico, for example, have seen strong equity market performance in recent time. Developed Europe, I would say, has been a bit of a challenge. We've seen UK equity markets falter a little bit. I think that's in part due to that. So yeah, hopefully that's helpful.
Okay, very good. Evan, thank you again. We certainly appreciate the insight and expertise. And a couple other questions for Marquette here, and I'm not sure, I'll let you guys decide, Chris or Evan, who might be best to respond to these. But Chris, I know you mentioned the 10-year Treasury exceeding 5%, and I think that's the first time that's happened since 2007. So certainly that generated a lot of highlights this week, at the end of last week and this week. So can you talk a little bit more about that for the participants to understand why that is such a significant financial indicator and what the ramifications of that might be on the economy and on portfolios?
Yeah, for sure. It's a pretty big factor, and certainly, we think about the yield on the 10-year Treasury as sort of a bellwether sort of economic data point that influences so many parts of what we're trying to achieve and accomplish. If we just link it back to our own sort of capital market assumption, there's a lot of inputs and a lot of assumptions in this large software model. But one of the most important is the interest rate environment in the U.S. and sort of what that term structure looks like, short rates through intermediate and long term. So, broadly speaking, 5%, as I said before, it's not maybe all that egregious of a level if you look back through history. I think if you go back to the kind of post-war period, the average yield on the 10-year Treasury has been like 5.2. So we're basically at sort of our long-term average. But it's been the path that we sort of went through to get to that 5% that has been problematic as of late, going from 1.5% to 5% in sort of an 18-month time frame causes a lot of volatility. I think there's two, sort of potential impacts that we think about from an asset allocator standpoint, for an investor standpoint, for a saver standpoint. You think about retirees. This is pretty beneficial. For the first time in a while, you can generate some significant return from probably the safest asset in a portfolio. You think about, treasuries backed by the full faith and credit of the U.S. government. So as long as we believe that the U.S. government will continue to make good on its debt payments, that should be the kind of safest asset in the portfolio, and you can finally generate some return there. The flip side is we think about from an investor standpoint, while it is a nice thing to be able to generate yield in the bond market, you think about sort of the impact that has for borrowers, and it can start to become a negative. So if you think about, corporations that borrow on a spread in excess of that yield, you look at some high yield companies and the interest rate environment might be 8, 9, or 10%. That starts to be fairly punitive when running a business and creating sort of that, capital structure, equity versus debt, and how you finance projects. So while I think it's probably an opportunity for investors, it could potentially be a pretty big headwind for companies. And to some degree, that's by design. As you have a higher interest rate environment, that slows down economic activity. And the Fed is sort of trying to thread that needle now of slowing economic activity enough to get inflation down without causing severe damage to the overall economy. So there's a lot of moving pieces around it. But I think, opportunity on one side and maybe headwind on the other side. And we're trying to sort of balance all of that as we think about, putting together a portfolio.
And Chris, you talk about, the slowdown of the economic activity and those whole rate increases trying to achieve that. But it's been pretty amazing how resilient the economy has been. So what is Marquette's outlook? I know you mentioned, the market has built in already the expectation of pauses and then cuts hopefully next year. What's Marquette's outlook on that? Because we all know how the market doesn't like things that they don't have built in already.
Yeah, for sure. I mean, I think there's always uncertainty in the forward-looking sort of view for capital markets. To some degree, that's a feature and not a bug. It seems like uncertainties may be a little more elevated today than it has been in the past. And as you think about going forward, we haven't seen a massive impact from these higher rates yet. Now, we did have a couple of banks that failed in the early part of this year. Likelihood of them failing anyway was probably pretty high. There was probably some mismanagement. But so we have yet to see really that sort of contagion effect outside of a couple small pockets of these higher rates. If you think about why, we had a 10 or 15-year period prior to this rate hiking cycle where interest rates were about as low as they could go, and they had been that way for a long period of time. So any CFO or even individuals that had the ability to sort of lock in a low rate of debt have done that. And you think about the mortgage market, normally when you see interest rates rise as they have, you would have seen housing prices decline by 20 or 30%. We haven't seen that in this environment. And it's because, so many people for so many years were refinancing lower and lower and lower, and maybe have a 30-year fixed mortgage at 3% that they're in no hurry to get out of. So it's going to take some time for these higher rates to really have an impact because so many parts of the economy have sort of decoupled a bit from higher interest rates. Now, it won't take forever. At some point, people have to move and you start to see sort of shifting environment. So kind of back to the question of our outlook, I think for the next 6, 9, 12, 18 months, barring some sort of shock that is usually, pretty difficult to see in advance, I think we're still fairly optimistic on sort of the ability for the U.S. economy to continue to generate pretty decent numbers. When you look at the jobs market, and it's been, as you said, incredibly resilient and sort of shows no signs of weakness yet. So, longer term, obviously, anything can sort of come into play and you're sort of looking for that black swan or that shock out there in markets. But barring that, I think we're pretty optimistic over the next kind of, 12 to 18 months.
Wonderful. Thank you. One more question, I think we have a minute or two here. So a submitted question, and Evan, I don't know if this might be best for you. What is Marquette's view of the American manufacturing prospects?
Yeah, I can start, and Chris, maybe you can add anything that I miss. I would say we're also fairly sanguine positive on that because of some of the things that we discussed in the presentation, those nearshoring trends. But also we've seen a lot on the government side to kind of incentivize domestic manufacturing, especially when it comes to digital infrastructure. The CHIPS Act, for example, was a big one. That was like a $300 billion statute that provides $300 billion in new funding. I think something like $38 billion of which is dedicated specifically to the manufacturing of these semiconductors and other technologically related things. You've got the IRA, the Inflation Reduction Act. You've got the Build Back Better campaign, all of which is sort of designed to incentivize folks to among other things, manufacture products here in the U.S. So I would say we're fairly constructive on that. Chris, I don't know if you would add anything to that.
Yeah, that's a good point. I think that sums it up pretty well. I think that the one thing, that we think about on that manufacturing trend, certainly the idea to shorten supply chains and to get more manufacturing closer to your customer base is something that really hit home for a lot of, organizations through that COVID timeframe, is you couldn't sort of get the inputs that you needed to your process. I will say, as we think about sort of the future of manufacturing here in the U.S., I think it tends to be, or at least the outlook for it tends to be highly sophisticated in the sense that, manufacturing here may not have the same labor market impact that manufacturing did 50 or 60 years ago. As companies are trying to build, new manufacturing facilities, there tends to be a lot of really high-end robotics in the process. So that's probably good from a cost perspective, maybe not as good from a labor perspective going forward.
Very good. Thank you. Okay, well, I think we are going to wrap up. Chris and Evan, again, we thank you for spending time with us today. A lot of great information. Obviously, still a lot going on out there in the world and the markets that we need to keep a close eye on. But we certainly appreciate your information and Marquette's foresight on some of this.